Okay, hello everyone, and welcome to this webinar brought to you by Trader's Log. My name is James Chen. I am the Director of Technical Research and Education at FXDD. FXDD is a global foreign exchange broker. Now, today, as you might know, we are going to be talking about a specific approach I have to trading Forex, and this approach pretty much underlies all of the strategies that I used on a daily basis, pretty much most of them. So hopefully you'll get some good information on that. And if you have any questions during the course of this webinar, please do feel free to type them into the question window, and I will get to them as quickly as I can. Okay, so let's get started real quick. As I always do before I get started, well, first of all, today's topic is TPB and the deep pullback. TPB means trend pullback breakout, and the deep pullback is one of my strategies that takes advantage of the TPB approach. So I will be talking about all that and providing you with charts as well to illustrate my points. Okay, so before we get started real quick, this is a risk disclaimer. Foreign exchange trading carries a high level of risk that may not be suitable for all investors. Do not invest money that you cannot afford to lose, and educate yourself on the risks associated with foreign exchange trading, and seek advice from an independent financial or tax advisor if you have any questions. I'm going to give you a few more seconds to read through that, and then we will get started. Okay, and also before we get started with the main part of this presentation, I would like to give you a brief introduction to myself. Let me go back real quick. A brief introduction to myself, just in case you're not sure who I am or what I do. My name again is James Chen. I am I'm not sure why it keeps going forward there. My name again is James Chen. I'm the Director of Technical Research and Education at FXDD. We are a global foreign exchange broker, as I mentioned. FXDD stands for Foreign Exchange Direct Dealer. And what I do is I do the technical analysis postings as well as take care of education for FXDD. Now, I've been an active Forex trader and analyst since the inception of retail Forex. It's a little bit more than 10 years now, and I use primarily technical analysis. And prior to the Forex market, I was trading equities and futures, but since the beginning of retail Forex, I've pretty much been focused pretty heavily on the Forex market. I am a chartered market technician, or CMT, which is a designation for technical analysts, and I'm also a registered commodity trading advisor, or CTA, registered here in the U.S. with the National Futures Association. I publish daily and intraday currency analysis that you'll find at traderslog.com, as well as on our website at fxdd.com. And I've authored numerous articles in such publications as Forbes.com, Futures Magazine, Technical Analysis of Stocks and Commodities Magazine, and SFO Magazine. My next article is coming out at SFO Magazine in February, and that will about this deep pullback approach that I'm going to be talking about today. I'm quoted on a regular basis by Reuters News, Dow Jones, Bloomberg, Associated Press, International Herald Tribune, as well as many other media outlets, and I'm the author of 2 books, Essentials of Foreign Exchange Trading and Essentials of Technical Analysis for Financial Markets, both of which were published by John Wiley & Sons in the past couple of years, as well as the DVD set High Probability Trend Following in the Forex Market. Okay, so that's enough about me. Now let's get going quickly with the main part of this presentation. Now, as I mentioned, the topic is TPB and the deep pullback. TPB stands for Trend Pullback Breakout. So let's go to this slide right here, just to give you an approach. Now, this what I'm going to be showing you now is simply my approach to my general approach when I take, when I'm looking for trades, looking for opportunities in the markets. This is my general approach, and this in and of itself is not a strategy, but I will be showing you a strategy that takes advantage of this particular approach. So this pretty much underlies all of my trading on a daily basis. What I'm looking for first, TPB, is to identify the trend. Okay, so that's the T, identify the trend. Number 2, I'm looking for the P, which is watch for a pullback. And then number 3, I'm looking for the B, which is trade the breakout. So identify the trend, watch for pullback, trade the breakout. This little chart here, this illustration, pretty much illustrates the point pretty clearly. Number one, down here, you've got the trend. In this case, it's an uptrend. It could very well be a downtrend. But for illustration purposes, I'm making it easier by showing you an uptrend. So we have an uptrend here. Number two, within any uptrend, I'm looking for a pullback. Okay, so within any trend, the meaning of a trend is really a net directional movement over time in one direction, whether that be up or down. So there's either an uptrend, a downtrend, or no trend. And I'm going to show you exactly how I measure trend in a minute. But within any trend, you're always going to have what we call pullbacks. Pullbacks could be called also retracements or corrections or what have you. Within a trend, we have pullbacks, and same to the to the downside as well as to the upside. So if we have an uptrend, a pullback goes down. If we have a downtrend, the pullback goes up. Okay, so pullback within an uptrend is called a dip. A pullback within a downtrend is called a rally. Okay, so we have here a pullback. Number three, we're looking for to trade the breakout. Now, as we can see here, this blue line right here represents a breakout. I'm going to show you exactly, on the charts how I measure or how I look for breakouts. But this illustrates the point here, the general point that I'm looking for a breakout. So that's represented by the blue line. Once you find your entry, and in this case right here, we're looking at the blue line as the entry. Once you find your entry, then immediately you could place your stop loss or your risk control. Okay, so that's represented by this red line right down here. Okay, why is that stop loss down there? Simply because that is the bottom of the pullback, the bottom of the dip. Okay, so right underneath the bottom of the dip is where I place my risk management. Why do I place it there? Because if price action goes down and takes me out at that point, basically what the market is telling me is that I'm wrong. So in terms of I tried to take advantage of a pullback, but that pullback was not really a pullback. Maybe it wasn't the end of the pullback, or it's a reversal, or it'll pull back later or what have you. But at that point, the market is telling me that I was wrong about looking for this pullback recovery, which is the breakout. Okay, so hopefully that makes sense. Okay, so we have a break to the upside here. We immediately define our risk by placing our stop loss, and we have our defined risk right here between the blue line and the red line. Okay, now, once we have defined risk, then we can set our defined reward. And that's extremely important. Now, whether you're looking at a 2-to-1, 3-to-1, 1-to-1, 4-to-1, what have you, ratio between reward and risk, that's how you're going to set your reward, okay, or your profit target. So once again, and we want to have, especially in trend following situations, we want to have our reward to risk ratio larger, higher than 1-to-1. Okay, so usually in most of my strategies, I'm looking for at least a 2-to-1 or 3-to-1 ratio, especially in a trend following situation. Okay, so that's it. We have the defined risk and we have the defined reward, and that is my general approach. And the underlying principle, of course, is risk control through stop loss. So you control your risk. You have a relatively large reward compared to your risk, and that's my general approach. Okay, let me show you on a real chart. Now this is a chart of an hourly chart of gold that was taken a while back, but here we have an uptrend in the form of this uptrend support line, this green line right here. Also, we have this, I believe this is a 50-period simple moving average, but that's another way to set the trend or to look at trend. So we've got a trend line right here that talks about the first part, which is identify the trend. Number two, we have a pullback. This pullback comes back to the uptrend support line. Okay, so that's a pullback. Number three, we have a breakout, and this breakout breaks out of this downtrend resistance line. You see this thin blue line right here? That's a downtrend resistance line. We see a break to the upside, and that's my breakout. Okay, and some people ask me, why not have it on the break above the high? The high of this, before pullback. Well, you could certainly do that, but I like to get into pullback recoveries, earlier rather than later. So this gives you a good point, a good possible point to get into a pullback breakout situation, if that makes sense. Okay, so trend, pullback, breakout. And this is on a gold hourly chart. So that's exactly what I'm looking at. Again, any questions, please let me know. Okay, now let's move forward real quick. Okay, so now that you know my general principle for trading, my general approach, I would like to give you an example of a type of strategy that I use that takes advantage of this approach. So this is what I call the deep pullback. Okay, so a deep pullback. Now, first of all, why are we looking for a deep pullback? That's a big question. A lot of people ask me, what do you mean by deep pullback and why are we looking for a deep pullback? Well, the reason to trade and the reason to look for a deep pullback, or any pullback for that matter, is because you want to get in at a cost-effective location. So basically what you're saying is if you're in an uptrend and if you want to trade the uptrend and you get in at a cheaper price, which is represented by the pullback, then you are basically buying something at a bargain. You're buying the euro dollar at a bargain if it's in an uptrend. Right now it's not, but if it's in an uptrend, then what you're doing is you're buying the euro dollar at a bargain if if you're going long, if you're buying. Now, in terms of shorting, the best place to get into a sell trade or short trade on a downtrend is when price goes up, because hopefully what you want to do is you want to sell high or sell short high and then cover low. Okay, just like in an uptrend, when you're going long, you want to buy low and sell high. Okay, so that makes a lot of sense. Now, why? Anthony, the question is, are you recording this webinar? Yes, I believe this is being recorded, so you'll be able to take a look later. Okay, on Trader's Log. Anyway, so why deep pullback? Well, the deep pullback is very simply, the more it pulls back, the better price you get in. Okay, a shallow pullback in an uptrend, when you go long on a shallow pullback, it only goes down a little bit, right? Now, if you have a deep pullback, it goes down more. So simply, you're getting in at a better price. Now, this is provided that deep pullback does not turn into a reversal. And that's what we have to be careful of, and that's why we have controls in place. We have confirmations in place that will help us decide whether or not this is a pullback or it's a reversal. And even if it does turn into a reversal, we have our very, very strong risk management in place that will take care of us. Okay, so what is the deep pullback? Okay, this is a 3 moving average pullback trade. So basically, we have 3 different moving averages, and I'm going to show you on my charts in a second. 3 different moving averages, the 200, the 100, and the 50. I usually trade this on the hourly chart because I found that it works pretty well on the hourly chart for the major pairs. I have several different major pairs. I have also the crosses, etc. So some crosses, some major crosses. So we have 3 different moving averages, 200, 100, and 50. These are simple moving averages. Now, we only trade with a trend when the 3 are in correct order, and this is what I call COMA, C-O-M-A, correct order of moving averages. It's a funny acronym, but it helps you remember it. Now, COMA is simply in an uptrend. Correct order moving averages, or COMA, is the longest term moving average on the bottom, and then above that is the middle moving average, and then the shortest moving average on top. Now, in a downtrend, it's simply the opposite. We have the longest period moving average on the top, followed below that by the next shorter moving average, and then followed at the very bottom by the shortest term moving average. So that's the correct order. If there is not correct order, if there's no correct order of moving averages, then we are not in a trend. Okay, according to the strategy, we are not in a trend, and we don't even touch it. We don't even look further at it. Okay, so if we're not in correct order, then we move on, and we look at another currency pair or another instrument. Now, we enter only when the stochastics pullback, okay, coincides with the price pulling back to the 100 moving average or more, the middle moving average. Okay, and I'll show you exactly what that means on the charts. We have our stop loss at the last swing because, once again, If in an uptrend, if you're going long, if price action breaks down below your last swing, that means the market is telling you that your trade was wrong. Your pullback was not really a pullback, or was a premature pullback, and you're wrong. So you have your risk management take care of that. So that's where you place your stop loss. And then what I like to do is I like to target 2 to 3 times my risk or better. Okay, and then you trail your stop loss. You can trail your stop loss to lock in break even and further profit. So let me show you real quick what this means. Let me go to my charts real quick, just to give you an idea of what I'm talking about here. Okay, and these I set this up beforehand. This is an hourly chart of British pound against the U.S. dollar. Okay. Let me take a look here. Okay, this is an hourly chart of British pound against U.S. dollar. Now, I'm looking for deep pullbacks. Once again, first thing I do is I look for the trend. Okay, so let me pull my crosshairs up here real quick. Do you see here? This is the 200 period simple moving average in blue, and then in sort of dark red, we have the 100 period simple moving average, and then in yellow up here we have the 50 period moving average, which is the shortest period moving average. Now, the correct order or coma of these moving averages is correct for an uptrend right here. Okay, as you can see, they're in correct order. Over here, they're not in correct order. Over here, they're not in correct order. Okay, now when you look at a downtrend, you take a look here. Starting from right about here, it's in a correct order of moving averages. Okay, right here. And it's simply 200 period on top, followed below that by the 100 period, and then the 50 period below that. So that's correct order for a downtrend. So that's number one. So over here we have a correct order, okay, and over for an uptrend, and then over here we have a correct order for a downtrend. Now what do? Okay, second, I'm looking for a deep pullback only. Okay, that's the name of this strategy, and that's exactly what I'm looking for. So deep pullback needs to go to the 100 period simple moving average, the middle moving average, or more. In an uptrend, what does that mean? That means that you're looking for the price to go at least to the 100 period simple moving average, this middle one, or lower. In a downtrend, I'm looking for price to go at least to the 100 period simple moving average or higher. Okay, so that's simply what that means. Now, a lot of people ask me, what if it goes beyond the blue line, the 200 period simple moving average? Well, I'll still take the trade. Okay, that's a very deep pullback. That's usually represented by a very deep pullback. But as long as my other signals are in place, I'll still usually take that opportunity. Now, okay, so number one, correct order moving averages. Number two, we need price to at least go to the 100 period simple moving average or more. Now, number three is we are looking for the stochastics to cross the overbought or oversold line. Okay, I'm using slow stochastics. I happen to be using an 833 setting for slow stochastics. Now, if you take a look here, what I'm looking for in an uptrend, and please listen carefully to this because some people get confused by this, but in an uptrend, we are looking for a cross above oversold, which is at the 20 line. Okay? Now, in a downtrend, we are looking for a cross down below overbought, which is the 80 line. So we're looking for stochastics in a downtrend to be above the oversold line and then cross and close below it. In an uptrend, we're looking for the stochastics to cross up above oversold at 20 and close above it. Okay, what do I mean by close? Well, basically what I mean is that if you have a candle and you have a stochastics here and it looks crossed up, okay, sometimes what will happen is it's going to move up and down, above and below that line. Okay, whether it be the oversold or overbought. So it'll go up and down until it actually closes. And if that close represents a cross above this line in an uptrend or below this line in a downtrend, then at that point I'm going to take that trade. Okay, so this is what we call, we have the TPB. First we have trend, then we got pullback. In this case, it's a deep pullback. Then we got the breakout, and this is the breakout I'm talking about right here. Okay, so this breakout above oversold. Now you may ask me, what about this one over here? It also did the same thing. Well, if you take a look at my crosshairs here, it did do the same thing. However, up here, it wasn't at that time, it wasn't a deep pullback. It didn't pull back to the 100-period simple moving average more. Okay, now, you take a look at this uptrend right here. Now, let me see. Okay, so you take a look. You got a pullback here. You got a pullback here. But I'm not taking those. Okay, I want to be able to. I want my strategy to give me solid rules as to when to get in, when to get out, etc. So I'm not going to be taking these. Although some of these may have been good trades. You know, let's take a look over here. This, you know, let me see. This would have been a good trade. It pulls back a little bit here. But how do you know that's going to stop or what have you? So. You know, you have a pullback here. That could have been a great trade to the short side, okay, to the downside. But I'm not going to take it because, you know, according to my strategy, which I've tested, which I have experience with, you know, this particular strategy that I'm using at this time, it's telling me that it doesn't fulfill the requirements for getting into a trade, and therefore I'm not going to get into a trade. Okay, now, how do you, once again, okay, so how do you set your stop loss and your profit target according to this particular strategy? Well, look, you get in, once again, you get in on when it crosses, so we have a downtrend right here. We get in when it crosses below, well, first of all, we have the correct order moving averages, and then we have a pullback that goes beyond the 100-period simple moving average, okay, and then we have a cross below. You get in somewhere around here, okay? Now, where do you place your stop loss? You place your stop loss right above. You could be, you know, a few pips above or what have you, just to give a little room there, but you put it right above that pullback because think about it. When you get in here short, okay, where my crosshair is right now, you get in here short, you put your risk management there, okay, so you're looking to go in short. Now, if the market comes up and takes you out, what is the market telling you? That that pullback was not a correct pullback to get into. Okay, and then you're out with a relatively small loss. Now, once you have your stop loss in and your entry, you have defined risk, and that's very, very important. That is what your risk is. Okay, so if you remember the TPB diagram, it shows you, you know, you have your defined risk, and then from there you can set your defined reward. And what is your defined reward? Well, really, it's according to how you want to play it in terms of, you know, your reward to risk ratio. How much more do you want your reward to be than your risk? So let's say I set it at 2 to 1. Okay, 2 to 1 is my reward or my profit will be twice my risk. Okay, so let's say I have that. Well, we have a lot more here. If you take a look here, if you went short here, we have a lot more than 2 times here. But, you know, you have to set your parameters because not always will you get great moves like this. For example, over here, you do not have a great move. You have a short, okay, and then you could possibly get 2 times risk there, and maybe not. Okay, so, you know, you want to be able to balance your reward to risk ratio and your percentage win ratio. What exactly does that mean? If I have time, I'm going to go through positive expectancy, how to measure your expectancy, and how to balance your reward to risk ratio and your percentage win ratio. What does that mean? If you set your, let's say you set your reward to risk ratio at 1 to 1. That means that your risk, you set your risk, or whatever your risk is, your reward is going to be exactly the same. Okay, so that means you have to win more than 50% of the time in order to make money. Okay. Now, if you have so your percentage win, but your percentage win ratio is going to be better than if you set your reward to risk ratio higher. Why? Well, it's a lot easier for price to move 1 times your risk than it is 2 times your risk, or 3 times your risk, or 4 times your risk. Okay, so you know, if you're looking for big moves, chances are your percentage win will be pretty low, okay? Because you don't, how often do you get those big moves that you could really take advantage of? Less. But once you do get those big moves, they're very, very profitable for you. But then you're going to probably be taking lots of losses, lots of smaller losses along the way. So, you know, reward to risk ratio is very high. then your percentage win ratio goes down. If your reward to risk ratio is very low, then your percentage win ratio goes up, and you just have to find a balance. Now, what I tend to do is I'm looking for mostly, between, like I mentioned, between 2 to 1 and 3 to 1, so twice my risk or 3 times your risk or what have you. Okay. Okay, now we have this. Okay. So we have this, now we have everything set up. So, you have your defined risk. Let's say right here you have your defined risk, and then you have your defined reward, and then, it conforms to the strategy now of the TPB approach. Now let me just show you a few examples here. So, over here, we see over here, okay, you take a look, let me move my crosshairs a little bit. Okay, you have correct order moving averages right here, okay? And you have a pullback that goes to the 100-period simple moving average or more. This would have been a great trade, right? Yes, it would have. You would have made a lot of money. You could have made a lot of money if you went long there. Okay, now, the problem here is it doesn't conform to my methodology. We don't have a pullback that crosses above oversold, and therefore I'm not going to take that. I'm not going to take that trade. Now, you may say, you missed a great trade there. Absolutely, I missed a great trade. But am I going to worry about it? No, I'm not going to worry about it because I don't want to bring my emotions into trading. Yes, I'm going to miss great trades. I'm going to also get, great trades. But I want my strategy to give me solid rules to whether to enter or exit into trades. And I have the luxury not to trade. So, so this fact here, that it pulls back, it doesn't pull back below here, for me, just means that I'm not going to take the trade, and fine, whatever happens, happens. I have my, I've tested my strategy. I have experience with my strategy, and the fact that it didn't give me a good entry into this particular trade, I'm not even going to worry about it for 1 second. Okay, now you take a look here, and there are plenty of pullbacks here, but I'm not going to take these either. Now I'm going to take this one right here. Why? Correct order moving averages. It pulls back below to the 100-period simple moving average or more, in this case below. And then I have a cross, just like I just showed you. You get in there, you put your risk management under there, you put your reward to risk ratio according to what it is, 2 times, 1.5 times, 3 times, whatever you want. And then here's the same thing. Okay, we have a cross above there. And everything's in place. That's an okay trade too. Over here, we see that we are in correct order moving averages as well. Okay, if you take a look right here where my crosshairs are, correct order moving averages, it crosses up above the stochastics. It goes way below. So as I mentioned, people ask me if it goes to the 200-period or more or lower, are you going to take that long trade? And I say yes. Okay, so we get into that trade right there. And then here you have lots of crosses. Okay, so you're not going to take any trades here. These are all crosses of the moving averages. We don't have the correct order. Okay, so and then over here it starts coming back into correct order. It actually comes back right here. Okay, would this been a great trade to get into? Yes. Okay, so it's a deep pullback, or a high rally to get into a short trade. We've got the cross of the stochastics, but we do not have correct order moving averages. Therefore, I'm not taking that trade. I missed another good trade, right? But I'm looking to find the highest probability trades I can. Okay, so now we move down. We got nothing here. It crosses back into correct order moving averages here. Okay, there's a pullback here. I didn't take it. Pull back up here. Okay, and I take this one. Okay, this is a very nice one, a really, really good one. Okay, and then it goes down. I make my risk reward there. Here, also correct order, same thing, goes beyond the 200 period, etc. I'm sorry, 100 period. It goes above that. I go short. This is not so great because we don't have a lot of follow through there. But you'll find with the strategy that you get the direction often very right. A lot of the times. However, depending on your risk-reward ratio, again, that will affect your percentage win ratio. Okay, now here's another one. This is a live chart, so here's another one right here. You have correct order right here for an uptrend. Although at this point you don't know that it's not going to continue as an uptrend, but you get in here. This is a good example here, and you got a little bit there to go, and then it crosses here. So we're not in correct order here. We're not in correct order here, and then now we have downtrend. But since then, nothing has happened. Okay, so we don't have any opportunities here. Let's take a look at dollar Swiss. Okay, dollar Swiss. This could be right here. You see, this is the most recent dollar Swiss hourly chart. Right now, we are at a critical juncture. We are in uptrending mode. We have the correct order moving averages for an uptrend. Okay, it went to the 100 period or lower. Okay, now we look like right over here, it has not yet crossed above, but once it does, that could be a potential opportunity to go long on a continuation of that trend. Okay, so hopefully that makes sense to everyone. Okay, now here's a good one as well. We have correct order of moving averages for an uptrend. Okay, I didn't point this out before, but we have a correct order of moving averages for an uptrend right here. Okay, now we have the stochastics hit this oversold line and then move up. Now that also to me represents this deep pullback. So not only if it comes back and hooks, and crosses above the oversold, but if it touches the 20 line and then it moves up, then that for me is another indication of possible deep pullback trade. Okay, so it does this and it closes above the 20. Now, right here, we have a good potential move here, and you get in right around here, which is a really, I'm sorry, even earlier, right around here, which is a really good place to get in. Okay, now you have your stop loss right under here, right under this last low, and then that easily hits all of your risk-reward targets. Okay, and going back in time a little bit on the dollar Swiss, lots of crosses here. We're not looking at that. Here's one trade, not a great trade again because not a lot of follow through. We got the direction correct, but not a lot of follow through there. Here's a good one. Okay, now this is what sometimes happens. So you got correct order moving averages here. We've got a deep pullback that goes beyond the 100-period simple moving average. Now we see a cross up above the oversold line. Okay, so everything's good. We get in. Okay, immediately it goes down. It does not take out our stop loss, though. Okay, because if it did take out my stop loss, then obviously I'm wrong. But it did it. Okay, so it moves down and then it continues and it hits our risk-reward ratio. Okay, so that's really good. Now here, same thing. Correct order for an uptrend. We see the same thing here. Cross up above, and then we see a very good move there as well. Okay, this did not hit my 100-period simple moving average. It would have been a good trade if it did. But not only did it not hit my simple moving average, 100-period simple moving average, but also the stochastics was shy of the oversold. Okay. Okay, so that's basically that. And again, if you take a look here, a possibility for some type of a trade within the next couple hours here on dollar Swiss. Okay, let me show you a couple others. This is Aussie dollar, hourly chart once again. Same thing here. This is a good one. Okay, a pullback, deep pullback. Correct order moving averages, deep pullback above the 100-period simple moving average. Goes short on this cross, and then we've got good risk reward right there. Same thing over here. Let me see. This is it went to the 100-period simple moving average. We had correct order, but we didn't have the stochastics line up right over here, so that didn't work. Okay. Now this one did. Now the problem here is, are you going to take this? Is it deep enough? Okay. It went to it just was shy of the 100-period simple moving average. Well, if you're going to be very strict about your strategy, which you probably should be, then perhaps this is not a trade you want to get into. Okay. However, it turned into one of the best trades available. But that depends on how strict you are in your rules, which you probably should be, especially if you're new to Forex or new to trading. Okay, and here same type of thing. Not a great trade, but it hits your risk reward nonetheless. we have an uptrending correct order moving averages, and then we have a cross down here, cross up. Over here, we get in, we got our stop loss, and we got a good move right there. Here would have been a good one, but we have crossed moving averages. We don't have the correct order moving averages, okay? And since then, nothing has really happened. Okay, last chart I wanted to show you before getting to some other stuff is this is the dollar Canada. Okay, the U.S. dollar against the Canadian dollar. Hourly chart once again. So here, correct order moving averages. We have a pullback move. Pulls back to the 100 period or more, and then we have this cross up above. We get into that trade. It's an okay trade. Does a lot of choppy stuff, but still an okay trade. We got the general direction correct. Same thing over here. We see the same thing here, and that's a good trade. From there, although there are lots of good potential trades, in hindsight, over here, it didn't conform to my rules, and therefore I'm not taking them. Okay, so here it turns into a downtrend. Okay, a downtrending correct order moving averages, and then here we have, you know, a pretty good move right here as well. Okay, to go short. And then since then, it's turned into an uptrend. However, we don't have anything good as of yet, according to the strategy. Okay. So hopefully you guys understood that. Let me take a look at this. The questions here. So your entry is when stochastics is back into 20 or 80, yes? Okay, my exact entry is in an uptrend, if you're going long, is when the stochastics crosses above the 20 line. It crosses and closes above the 20 line. Okay? In a downtrend, my exact entry is when the stochastics crosses and closes below the 80 line. Okay, so it should, stochastics, once again, in an uptrend, the stochastics should have been underneath oversold or at oversold, at the 20 line, or underneath the 20 line, and then crossing above. In a downtrend, the stochastics should have been above the 80 line or at the 80 line, and then crossing down. Okay, hopefully that makes sense. Okay, and there are many different ways to exit besides what I just talked about, which is setting your risk-reward ratio. Another way to do it, and let me just show you this real quick. Another way to do it is, you know, you set your, you know, like I said, this is all setting your risk, okay, your risk-reward. But optionally, what you could do is you could move your stop loss. So let's say you get in, you have defined risk, and then price moves in your direction. At some point, let's say at 1 times risk, you can move your stop loss to break even. Okay, and there you're basically, you know, you're not going to lose any money on this trade. So you move it to break even. If it continues to go in your favor, let's say it goes to 2 times your risk. Okay, price goes to 2 times your risk, then you can move your stop loss to 1 time your risk, which is, you know, when you're in profit, if that makes sense. So 1 times your risk when you're in profit, and therefore you've locked in 1 times your risk, your original risk. Okay, so that's another way to do it. Now, yet another way to do it is to enter a trade with smaller positions and stagger your exits. So let's say price goes in your favor. Okay, so once it goes to 1 times your original risk, you can take off 1/3 of the position. Now, once it goes to 2 times your original risk, then you could take off and take profit on the 2nd position, and then maybe you could run the 3rd position for 3 times your risk. Okay. So if you have any questions about that, please let me know. So that's how we size our positions and take our profits. What I like to do, and it's very important here, is I like to limit my my trading, you know, the dollar amount of my risk to 2% of my overall trading equity. Okay, below the 2% or below. So if I have $10,000 that I'm trading, I like to make my defined risk, my overall defined risk on a single trade at 2% or below. So that would be, if I have $10,000 in an account, that would be $200 is my risk. Okay, on one particular trade. So so there, I mean, the real name of the game here is preserving your capital, and you know, trying to catch the big moves. Okay. Now, before we go, I wanted to quickly give you this establishing expectancy formula. And this is very important. Why is this important? Well, this is really the basis of how you become consistently profitable trading in any market. Doesn't matter which market. So when you establish expectancy, how do you do this? And what does it mean? Well, first of all, you need to make a lot of trades. If you have a specific strategy, whether it's a deep pullback strategy like I showed you or your own strategy, it doesn't matter. You need to test it over time, and you need to keep a trading journal. And this trading journal should include, how much you made on each each trade, how much you lost on each trade, as well as your reasons for getting into a trade, and the date and time of entry and exit, etc. You should have all of this for each trade that you make. Once you have a lot of trades and you could see exactly what you made or lost on each one, then you could establish expectancy. What does this mean? This is a simple formula. Okay, this is very, very easy. E, which is expectancy, and this should tell you how you're expected to do over time with your trading, and you should keep doing this formula, over time. And you could actually do it in an Excel spreadsheet. You could set up your wins, losses, etc., and then automatically have your expectancy show up in one of the cells with this very simple mathematical formula. Okay, so you establish your expectancy by this formula. E is expectancy, and E equals 1 plus W over L times P minus 1. What does that mean? 1 plus average winning trade divided by average losing trade. Take all that, you times P, which is your percentage win ratio, and then you minus 1. Okay, so an example here. Let's say you have 10 trades. Okay, I really don't think, this is not a good example because there are only 10 trades here, but let's say you had hundreds of trades, which is even better. But for purposes of keeping this math simple, let's go with 10 trades right here. Okay, 10 trades, 6 winning trades and 4 losing trades. That's from your journal. Your percentage win ratio, or P, will then equal 6 over 10, or 60%. If you have 6 winning trades, okay, of the 10 trades, these 6 winning trades were altogether $2,400 in total profit. Therefore, your average winning trade, or W, is simply the $2,400 divided by your 6 winning trades, which is $400. Now, if you have these 4 losing trades, you lost a total of $1,200. Okay, so then your average losing trade is, or L, is 1,200 divided by 4, which is equals $300. You plug all this into the expectancy formula, and you get 0.4 or 40%. The most important thing here is you want to have a positive expectancy. You do not want to have a negative expectancy. If you have a negative expectancy, that means you're losing money, and you're consistently unprofitable. If you have a positive expectancy, that means you are consistently profitable, at least for the period of time that you had all your trades entered in. Now, 40% is pretty good. It's pretty good. What does this mean? A positive 40% expectancy means your strategy returns 40 cents per dollar over time, which is very, very good. So, and that's the type of thing that you want. So, once again, you have to balance your reward to risk ratio and your percentage win ratio and come up with a way to trade that gives you a consistent positive, high positive expectancy. And that's really the key to playing this game here, or trading in general. So you need to establish expectancy. You need to have a strategy and a risk management profile that helps you establish a high positive expectancy. Okay. Let me take a look here. Some questions. Do you have to with the computer all the time? Or software to identify when the rules align? I'm actually having this programmed into an EA, an expert advisor. So you could either, up till now I've been doing it manually, which means I'm looking at the computer. Okay, and I'm on the charts all day long, pretty much every day, every trading day. So that's what I'm looking at. I'm looking for setups, whether it's this strategy or some of my other strategies that I use. I'm looking for setups all day long. Now, you could do that, or you could try to put this into some type of automated strategy, which this is conducive to doing. So, as I mentioned, I'm doing this as we speak. I'm trying to put this in motion as an expert advisor. What is your stochastic set at? Again, this particular one, I set it at 833. I've tried different ones. It doesn't make a huge difference. I've tried 533. I've tried 1433. I've tried 833. And, most of the time I'm using 833. Just, again, not a huge difference, but, it seems to work pretty well. Let me take a look here. Okay, and yeah, another question about the recording. I can't actually email you the recording, but you'll be able to find it, I believe, on traderslog.com. You'll be able to find the recording probably sometime tomorrow or so. Okay. Let me see. I had some principles of high probability trading, but I don't think I'm going to go through those right now. And I think that if there are no more questions, I think that might be it. Now, if you want to have a copy of these slides, please feel free to email me and at jchen@fxdd.com, jchen@fxdd.com. So, feel free to send me an email, ask for the slides. I'll be more than happy to send it to you. John, is this strategy your most successful one that you have used? I have a lot of strategies that I use. This is one of the more successful ones, yes. I'm not sure if it's the most successful, but it's one of the more successful ones. And I present strategies all the time. So, if you come to FXDD and listen to my webinars, then you can certainly do that. Okay, have you tried on a shorter coma? Shorter correct order moving averages, KK. No, but you could certainly experiment. I mean, see what works for you. I tried a couple other combinations in the past, long time ago, but I found that these work very well. The ones the 200 and 150. Okay, great. So thank you, everyone, for your time today. Take a look at the recording. Email me if you have any questions, and have a great day. Thank you very much.